Maybe first question, so could you introduce yourself and Invesco for those who have no clue how Invesco is, despite your big size?
So yes, Paul Sims. I head up the EMEA ETF fixed income and commodity product management at Invesco. So maybe just a quick word about us. Hopefully you have heard of us. We're a $2.2 trillion global asset manager. One thing that maybe some of you won't know is that almost half of our assets are in ETFs and index strategies. So we just hit the $1 trillion mark in assets under management. We've been in the ETF business for over 20 years now, have more than 400 ETFs, and a very strong global presence. And we've been first to market in many strategies. What I'm hoping to sort of highlight today is the growing importance of ETFs for being able to manage liquidity, cash management purposes, moving out of just traditional money market funds, cash at bank, and being able to make that cash work a little bit harder. So my starting point on this is just to start with the liquidity continuum. Now, this is just a graphic to try and illustrate where various investors could have their cash. Now, back at the very bottom left of this, you've got your cash at bank, or money market funds, the more traditional areas that are very safe, very secure, but tend to give you slightly lower returns than you might be able to get further out. You could, with the ETF market, you can move into overnight swap ETFs, floating rate notes, you've got ultra short debt funds out there, and also AAA CLOs. And these are just opportunities to really make that your liquidity work harder for you, how to actually make that cash drive your returns. And this slide just tries to highlight, one of the concerns or one of the things that cash can be overlooked as an asset class. It's something that you hold when you've sold some assets. It might be there for a short term, it may be there for longer term. But almost all portfolios have some cash allocation. To be able to enhance returns and able to be able to maximize those returns, you really need to break that cash down into what you need for immediate liquidity purposes, and then maybe for the longer term cash management purposes, and being able to put it to work in asset classes that may be less liquid or a little bit more volatile, but can give you the increased returns that you'd want on that. So just looking at this, you can break this down into your short-term cash needs, your immediate liquidity, so stuff that you might need on a T0 basis, such as cash at bank, AAA liquidity funds, your more traditional means of managing cash. If you can still have very short-term cash needs, but can actually go on a T+1 or a T+2 settlement cycle, you can look at longer-term money market funds or overnight swap ETFs. That will be one of the topics that I talk about. If you have longer-term cash, you could look at ultra-short duration funds or ETFs, floating rate note ETFs. And then if you've got more strategic cash, if this is there for a much longer term, you could look at something like AAA CLOs. Now, these are a relatively new product in the market. The regulation changed about a year ago. So the first AAA CLO ETFs only were launched in UCITS format at the beginning of this year. So a fairly new asset class within the ETF business. But that's definitely for longer term cash and investors that can invest for a longer term, take a little bit of volatility, but can look to maximize those returns. And then, why is now a good time to be looking at this? If you look at that middle chart, just the amount of money that's in US money market funds at the moment, we've hit $7.5 trillion. A huge amount. If you'd looked at it in Europe, you'd also see a similar shaped graph, but not quite as large a number. But there's a huge amount of money sitting in cash and in money market funds at the moment. But we are seeing investors starting to put this to work. If you look at the left-hand chart there, this is the net new assets in the European fixed income business by category. And that pink line, the top line at the top, is basically cash management. So it's a range of cash management, whether it's ultra short or FRNs, that type of ETF. And you can see that's been the strongest category so far this year. Now, the European ETF business has had a record year. There's been 340 billion of net new assets overall. In fixed income, it's a record year. We're close to 80 billion of net new assets. But about a quarter to a third of that has been in money market cash management ETFs. They're now up to close to 70 billion in assets under management, and a very strongly growing asset class as we see more investors looking to put their money to work and make it sweat a little bit harder for them. And then just the timing of this. Right now, obviously, rates are coming down. We've seen rates halve in Europe from the peak, but they're coming down in the US and in the UK. So every basis point counts. You're looking at how to maximize those returns in an environment where rates are falling, and you need to try and maximize those returns. So with that, I will look at how the overnight swap returns can actually help. Now, this is kind of the first step out on the liquidity continuum, the first step out from money market funds. On that initial graphic that I showed, they're just a little bit more risky, but can offer higher returns than just pure money market funds. And I think it's important to highlight some of the differences between cash at bank, money markets, overnight returns, and how the differences, why there's differences, why they give you different returns. Now, obviously, cash at bank or your custodian is instant liquidity. There's no fixed maturity on it. It's constantly available, but it's going to give you fairly low returns. That's going to be close to the overnight rate. You're not going to get anything in addition just by holding it at bank. You could take the step out into short-term money market funds. The advantage of these is that they can offer you a T+0 settlement, so same-day settlement before a cut-off period. But they are highly regulated, highly restricted, which means that very low weighted average maturities, average total maturity limit, means that they are not adding a huge amount over and above what you might get with cash at the bank. So tightly regulated, very safe, but not a huge amount of additional return. You could move to something that's slightly riskier. Not really very risky, but money market funds will give you a little bit more return. But they tend to, a lot of these more variable NAV money market funds will settle on a T+1 basis. So if you still need this for immediate liquidity, they might not be totally suitable. However, they will give you ideally a return over those short-term money market funds and over cash at bank. And finally, just looking at where overnight return ETFs fit into this. Now, overnight return ETFs will settle on a standard ETF settlement cycle. So their standard is T+2. What they're trying to do is provide you with a return on overnight rates, but because they're swap-based, there is actually a performance enhancement that banks are willing to pay, basically due to balance sheet management. So they will provide a return over and above that overnight rate, and they're ideal for investors that aren't looking for any additional volatility from additional duration or credit risk, looking at that overnight return, but looking for the benefits that you can get through the ETF structure and that swap-based mechanism. Just to put it a slightly different way, just where they fit in, and we've looked at this as sort of the potential return versus the potential risk. Those money market funds very close to cash rates, close to overnight rates. If you take one step out, you've got the what we'd class as maybe just potentially slightly more risk, but you're getting an additional return based on that swap-based structure. Now, although we've shown them as being slightly more risky, basically the only time that risk comes into play would be if one of the counterparties, the swap counterparties, actually defaults. Now, we're only going to be having swap counterparties that are very highly rated. The credit rating is monitored the whole time. So actually, this is an event that would be incredibly rare. And we've been running this platform for 16 years now, and it's something that we are experts in. So basically, the only risk you have is in the event of that default, whether the basket of equities that the ETF is holding isn't matched to the underlying NAV. Now, as I say, that would be an incredibly rare occurrence. And actually, if you're looking at that versus money market funds, you have some risks there as well. So while it's potentially more risky due to the swap-based nature, it's not particularly a huge amount riskier than maybe investing in physical securities. And then just the idea of what these can actually produce. So we launched 3 of these products at the end of October, but we've created the simulated performance of them over what would have been the last year, based on the swap economics that we can actually get. Now, in euros, we can get we're being paid a swap fee of 43 basis points over overnight rates. So you're enhancing that after fees by 33 basis points. You're getting similar levels in dollars and euros, and what you can see is that just enhances overall returns. The question then is why do banks pay it? Well, it's down to balance sheet management for them. They're looking to manage their balance sheet efficiently. They will have equities on their trading books that need to be financed. If they have to finance them internally, they have to meet internal funding rates or fund it in the market. That is costly. They may also have to issue regulatory capital against it if it's longer term equity holdings. Effectively, the way the swap-based ETF works is that when there's a creation, they will deliver us a basket of equities, very tight rules around this. We will pay them the return on that basket in return for them paying us the overnight fee, the overnight rate, plus a fee. So effectively, this is something that benefits both sides of both counterparties in this. The swap provider will get benefits of efficient balance sheet management. We're getting the benefits of them paying us an additional fee over and above what you might get for the overnight rate. That's just the trading details. And then the other one I wanted to talk about today is just maybe for that much longer term cash, AAA CLOs. As I said at the start, these are something that are relatively new in the ETF market. The first ETFs on AAA CLOs in the US were launched about 5 years ago. They've only been around in Europe for about a year now, so regulation changed to allow them to be issued for ETFs to issue AAA CLO-based ETFs. Now, in my mind, this is one of the best kept secrets. It's a 1.4 trillion market. Normally, when I'm looking at new products, we're looking at areas where there's new issuance and a growing market. This has already grown to 1.4 trillion. You can see the graph on the left-hand side. And with that growth in the US already, we're already up towards 35 billion in ETFs, assets under management, across both the US and Europe. So what are CLOs and why do they offer it? They are basically a debt security that's representing a securitized pool of senior secured loans. Now, those senior secured loans are on average rated BB, but because it's a securitized product, what you are actually doing is a CLO manager is packaging this up and selling it off in tranches with different risks and different return criteria. So for us, we're just focused on the highest rated AAA part of the market. It's the largest and the most liquid. It's just over 60% of the overall structure, and it will tend to offer a yield of roughly Euribor plus 130 basis points. So it's being able to use that securitized structure to be able to create the more highly rated tranche with all the subordination below it, which gives it the protections and why it's AAAs and AAs for that matter have never suffered an impairment in their history. The reasons to like AAA CLOs, attractive relative income, floating rate feature means that they've got very low duration and low interest rate sensitivity, structural advantages due to the way that structure of the CLO works, and then diversification. So just looking at these in turn, the relative level of income there you can see on the left-hand side of this slide is dollar-denominated CLOs versus other comparable asset classes. On the right-hand side, euros. And what you can see is that relative to comparable asset classes, you're looking at something that has the highest yield than other AAA assets, higher yielding than even broad investment grade, which will be lower rated. But the important thing here is that the duration is incredibly low. If you look at the pink diamonds, duration here is incredibly low relative to those other asset classes, which leads to much lower volatility. Sorry, there's a lot on this slide. The left-hand part of the slide just shows you the steady income stream relative to the next graph, which shows you the price return of the overall total return broken down by price and income of a broader, higher duration corporate bond index. I mentioned that the structure has never experienced an impairment. If you look at this data goes back 30 years or more, back to the early 90s when the CLO market started. AAA and AA tranches have never experienced an impairment. And actually, even that goes through post the dot-com bubble bursting and the financial crisis and COVID. The structure works exceptionally well. And then diversification. It has low correlations. CLOs have low correlations with other asset classes, which can help just diversify your overall cash management portfolio. From our perspective, very strong presence here. It brings together two of our really strong parts. I mentioned the $1 trillion ETF business. We also have a 45 billion plus private credit team with 150 team members, around 4 offices globally. And we've been doing this for a very long time. So we have the expertise to be able to manage the AAA CLOs within that ETF format. Finally, trading details. And I will hand back to Francois.
Yeah. So thanks a lot. So first question. So what will be the accounting treatment of these products? Do you think that we could qualify for cash and cash equivalent?
So these will not be exactly like money market. They'll be different. So these
they
are
will
about,
not fulfill the 4 criteria to
no.
get
So
qualification.
these are about. These are for longer term cash
Investment.
management. They're different to, as I say, true money markets or being able to meet that treasury requirement.
So we dedicated to be a portion of your cash, the one you can keep for longer, and the one you don't want to be offsetting your debt if you have any debt. Okay. Yeah. How do you see the role of this ETF for liquidity management, because it's evolving quite fast? So in the coming years, how do you see the product going?
So I think, if you look at just the overall growth of the ETF business, it's been growing very rapidly. As I say, this is a record year, up to 340 billion net new assets this year, close to 80 billion coming into fixed income ETFs in Europe. And of that, we've seen over 20 billion come into cash management type products. That to me signals not only there's strong growth in the ETF business, but investors are looking at ways of making the cash work harder. The whole concept of it can be left at bank at custodian, it could be put into money market funds, but for those longer term cash holdings, to try and make it work for you a little bit harder, looking at opportunities that are out there. As I say, something like a swap-based ETF wouldn't be available elsewhere. You need the ETF structure because that's the way it works best, or the way it works, and that's something that we've been doing for the last 16 years at Invesco. Or the likes of CLOs, until recently they just weren't available outside of the largest institutional managers that could buy 100 million, 150 million primary issuance. They weren't available. So the ETF market is allowing investors that access point to AAA CLOs.
And also to diversify, because some of our members have such a pile of cash that they need to diversify and to invest in so many different funds. And at the end of the day, they could be short of a fund, depending on their criteria for the selection of a fund, a money market fund. But that could be an alternative to go a step further. Because
exactly. These should all be sort of viewed as I say, I started off with saying about the liquidity continuum. So this isn't trying to replace any current allocations. Everybody needs that instant liquidity and the highly regulated money market funds. But these can complement it with allocations to the overnight swap ETFs. You may want to look at floating rate note ETFs or AAA CLOs. These are all about how much cash you need for immediate liquidity versus using it as an asset class that is actually a return-seeking asset class rather than just a liquidity allocation.
And so you said that in the States, it was started in the States because of the reform of the money market fund, you think, or it was just an alternative product that they created?
In all honesty, the way the US market has grown is a large part of it is down to tax treatment over there, and the advantages of ETFs based on the tax system there. We don't have the same advantages in Europe. However, from an investor standpoint, the liquidity of the ETF market and providing an access tool has become incredibly valuable to a huge number of investors. But it's still in its infancy. It seems crazy. reached $3 trillion in AUM this year in the European
amazing.
ETF market. But if you actually look at the proportion of investors that are actually using it for allocations, it's still relatively small. So this has this is just
Huge
the start
potential.
of the journey. And if you look at what's happened in the US, they're ahead of us.
It gives you an idea of where it could go.
I think we'll just continue to grow and grow.
Okay. And if you want to compare the contract cash management ETF with the traditional money market funds, so what will be, to go more into the details, the differences between the two products?
So again, part of it is regulation.
Of course.
So the who can invest in it.
It's fair to say that money market funds are highly regulated, or maybe
Exactly.
the most regulated product in asset management, I would say, yeah.
But you have you have the high regulation, you have the really tight restrictions, and the potential for same-day settlement up to a cut-off point. So you have that immediate liquidity. Now that's very important for a lot of investors.
Yeah.
They require
Daily
that, they
liquidity.
require the safety and the regulatory side of it. And within that, the regulations on that, I highlighted the weighted average maturity, the overall sort of maximum maturity on a money market fund. These ETFs are different. As I say, they're a complementary allocation.
Yep.
They all work on a T+2 cycle. Now, provided you don't need same-day settlement and you're looking to buy and sell other ETF-like securities, which are also on a T+2 settlement cycle, then this works perfectly fine. So these are ways of effectively making that liquidity work harder. They are not money market funds. They are not replacements. They're not going to give you that same-day liquidity. But this is about how you can. It's all about, in my mind, cash segmentation.
Yeah.
You segment your cash into this
Different
is what
buckets.
I need on an average daily basis. This is what I might be able to do for a slightly longer term. And then, maybe for something like AAA CLOs, they are more volatile, but they do give a higher return. Therefore, they may actually be something that is a much more strategic allocation rather than for liquidity purposes.
No return without risk. So, but okay, it could be a sort of complement for your strategies. No, I guess a big question will be for corporates for you to educate the market and to explain to the corporate that it could be a product on top of the existing one. So we still have some efforts to do together to explain to our member that it could be an alternative to their classic strategies of investment short term.
Indeed, and that's exactly since we only launched the overnight swap ETFs at the end of October. This is what we're working on with our colleagues in our liquidity funds and also our low duration, actively managed fixed income funds, to put this together as just a whole package, as a solutions-based approach to, you need a certain amount in money market funds, certain amount cash at custodian, but here's some alternatives for that longer term cash that you can try and just make work a little bit harder for you.
No, but it's certainly a topic we will readdress because we are discussing with your team in Luxembourg to have lunch and learn sessions, so where we could address a few new products and to address specific questions. So it's certainly something that we will readdress. So thanks a lot, Paul, for this presentation. And if you have any further question to Paul or to the team, Priscilla there and some others, do not hesitate to talk to the team later on. Thanks a lot.
Thank you.
Cheers.